Greetings. I'm your host, M. Toussaint, and welcome to another episode of This is Revolution podcast. So glad to have you guys here with us tonight for what will hopefully be an enlightening and informative conversation about the economy. Earlier this week, we kicked it off with a discussion about capitalism and emotions with Ashley Frawley. Then we had a supercharged White Guy Wednesday with Matt Crispin before having a chill stream therapy session about self-care instead of wages for teachers with Chicago Union teacher Kenzo Shibata. So if you're enjoying what we do here and want access to the post-show champagne room, there's only one way to be there's only one way. Become a patron. For as little as $3 a month or $30 a year, you can have access to the champagne rooms past and present, be a part of the live audience for the Mau Mau Hour, and join us for the Always Ruckus movie night. Tonight, our guest host is the super brain with no Coca-Cola brain freeze, C. Derek Varn. I'm going to bring him in now.
Hello, and I'm not drinking Coca-Cola right now. I'm drinking seltzer water, so
Look at that. Who are you even without your Coca-Cola?
still carbonated.
So carbonated. How's your day going? How are you feeling? Are
I'm
you ready to
okay.
talk about the economy?
I'm always ready to talk about the economy. It's like what I do. It's a large part of my own show. It's a large part of what I do here. And since I am increasingly Doctor Doom, talking about the economy is a good way to be all doomy. So,
That's
um,
true.
I'm ready.
Well, if Jack Rasmus is also doomy, then it's just the truth. It's not doom.
Hmm.
That's what I think. So let's bring in our guest for tonight, the illustrious Jack Rasmus.
Hello.
Hello. How are
Good
you
evening.
today?
Fine. Good evening. Glad to be
Excellent.
here.
Good to see you. So let's just jump in onto our topic for today. De-dollarization. Is it accelerating? According to a recent Guardian article, it is expected that the global use of the US dollar as a currency may decline further to 40 to 45% in the next 2 to 3 years. What are the potential consequences for the US, including the fans of multipolarity? Varn, you want to tackle that one?
I mean,
Let's
one of
start
the
with what de-dollarization is.
yeah, de-dollarization is in this scenario just the dollar not being the primary reserve currency of the planet. In the specific instance, most of the current disuse of the dollar is because more and more countries are buying um, oil in yuan are in their native currency. There's increasing currency deals being made with China in particular. Um, Also, China is part of the reserve currency. Like the yuan's become a slightly larger part of the reserve currency basket. Um, there was a lot of predictions last year, at the beginning of this Russia-Ukraine war, that we'd see rapid de-dollarization, and at first we really didn't. In fact, what we saw was the dollar get stronger, and that's actually part of why there's been some de-dollarization. It's just it cost other countries a whole lot right now to get USD on the open currency market. Um, Now, as for the implications of that, I'm actually not sure. I'm not sure that China wants to be the same kind of currency hegemon that the U.S. is at this point, because it would imply some things about its internal economy and about its ability to control its own currency. Um, I'm not sure uh, what it means for U.S. We seem to have a weak uh, banking sector and a lot of private debt right now, a ton of private debt right now in the US and Europe. And I'm not sure what it means in the case of the euro being really hit by a lot of these uh, changes in and what is being used as a reserve currency, and the euro and the eurozone seeming economically pretty weak, and UK seeming like almost like a basket case.
Dr. Jack, is de-dollarization accelerating?
Well, it's hard to tell if it's accelerating, but it's certainly the momentum is in that direction. I don't think this is the dollar's going to collapse overnight, but certainly it's clear in the longer, maybe intermediate run that less use of the dollar is on the horizon. The dollar rose last year largely because of U.S. interest rates rising. And of course, when U.S. interest rates rising and the rest of the global economy is slowing for various reasons we can get into, then the demand for dollars increases. In other words, offshore capitalist investors, businesses, whatever wealthy people want to put their money in a safe place. If the dollar rises, then you've got bonds rising and other investments rising in value. So people want to buy dollars with their, let's say, Argentine pesos. They want to buy dollars, which you got to do before you can buy treasuries or before you can buy other assets in the United States. So the U.S. is a safe haven when other assets are collapsing in the rest of the world because of recession, raises the demand for the dollar, which raises its price. And other factors too, like higher interest rates, you get a better return in the U.S. than you do in Argentina, whatever. So safety and better return increases the demand for the dollars, which drives the dollar up. Now you got to realize that the dollar is the linchpin of the U.S. global economic empire. And as that, the dollar for decades now is the main currency with which people trade, countries trade. So it's the main trading currency. It's also the main reserve currency that you keep on hand in the banks and so forth. So you got to distinguish between trading currency and reserve currency, and it's both. And just because one declines doesn't mean the dollar is going to fall through the floor. So you got this rising demand for the dollar, and the dollar is the key currency, particularly for buying and selling commodities in the world. All commodities virtually are traded in dollars. You're going to have dollars to buy a global oil, or at least you did. And other industrial commodities just as important as oil and natural gas, like aluminum and nickel and palladium and all these things that all the electrification products, computer products, automobiles, whatever, depend upon, all traded in dollars. And what's happened is the war and the sanctions here have accelerated the whole process of shifting from the dollar, have accelerated sanctions, on Russian oil and natural gas and so forth, has resulted in higher prices, of course, for these, all things equal, for these industrial and other commodities, agricultural goods too. Prices have increased. And the fact that the dollar is rising because interest rates have been rising in the U.S. because of inflation, because largely of supply problems related to the war and the sanctions. You see, all these variables are interrelated. And if you talk about one, you almost have to talk about some of the other. But the inflation in the U.S. Has to do with a number of things. One, coming out of COVID, corporations started price gouging in order to make up for the loss of the revenue they had during COVID. People now had some more money, so demand forces added to that. But it was mostly corporate price gouging. And when you eliminated the rent controls, the rents went up. And so that's driven inflation up, but also the industrial commodities and oil and so forth because of the war and sanctions at the same time. So there's global forces decreasing the supply of these key critical commodities, and you got demand forces, and you got COVID and reopening. All these have driven inflation. About 60% of inflation in the U.S. is really supply side. It's not demand side. It's not that
Mhm.
people have so much money. If you look at most of the middle class or working class, it's not that their wages are rising. No, in real terms, no. It's not that they have all this money left over from COVID relief. No, that was gone long ago. Um, Basically, they're borrowing more. Credit card use is at a record level, and people are even taking out installment loans to pay for their necessities going on. So households are really stressed with debt, and so are a lot of businesses. And then, of course, we know the government debt has really accelerated as well, which we can get into as a separate uh, analysis here. But we got all this inflation, and the Fed has responded with raising interest rates. But you got to understand, raising interest rates only addresses the demand side of the inflation, not the supply side. The Fed can't do anything about supply
Mhm.
forces driving inflation, the sanctions, the global supply chains, price gouging. The Fed can't do anything about that, and they even say so that they can't. So they're attacking demand, they're attacking wages, and you listen to Jerome Powell, the Fed chair, and his presentations every time the Fed raises rates. It's all about there's too much prices in services, and what we got to do is cause more layoffs for workers in the service sector, so they have less income, and they won't then cause demand side driven inflation. Uh, but if only 30-40% of inflation is demand, what you're doing is really taking supply side problems and geopolitical causes, sanctions and war, out on the backs of the middle class and working class, making them
Mhm.
pay for it with unemployment and so forth. And that's why inflation has not come down very much, even though the Fed raised interest rates at its most rapid rate in the past year, 5 percentage points. What do we got? We went from 9 to about 5.5%.
Yep.
And as I've been saying, you cannot raise interest rates more than 5.5% without precipitating financial instability in the banking system. And we saw that beginning because rates have hit the 5% level. So the Fed's and monetary policy is between a rock and a hard place. They can't raise rates enough to take enough out bite out of demand to bring inflation down to their 2%. They're never going to get it to 2% again. And if they raise it more, they precipitate a banking crisis, which precipitates a credit crunch, which causes a deeper recession, which we're on the cusp of here as well. But raising interest rates causes the dollar to rise, to get back to our initial point here. And because the dollar is the global currency, if the dollar goes up, all these other currencies are in effect tagged to the dollar. And if the dollar goes up, they go down. And if those currencies, all things equal, there's other forces there. But if they go down, well, what does that mean for Argentina and some of these other countries out there? If their currency collapses, which it has, well, that means their import prices go through the roof. They got to use more Argentine pesos to buy imports.
Mhm.
And it also means and that means import inflation drives the general level of inflation even higher in those countries, which means they have to raise their interest rates to bring their currency up. And that means they've got recession deeper. And that's what's happening in most of the world. We've got more inflation. We've got more currency instability. We've got more unemployment going slowly, growing around the world because of the dollar and the dollar rising. Now, the dollar rising is slowing down now because it's pretty clear that the Fed isn't going to raise it much more. And also, it's pretty clear that we're slipping into a deeper recession. We've been in a recession for a year here, I believe, but now it's going to get much deeper because we got a credit crunch that's emerging. Banks aren't going to lend because of the banking crisis as much as they used to. You see how these causes precipitate and have feedback effects across the various causations here. Uh, But basically, the dollar is not going to continue to rise as much. So to some extent, that sort of mitigates against the trend of going to other currencies, but not very much. I think the long run, very clearly, countries around the world see what the U.S. has done here with the war and the sanctions and the rising dollar, and they want to get out from under that cause because they don't have control of their domestic economies because they're part of the economic empire. So the trend, I think, is towards looking for other currencies, and of course, the Chinese yuan is the primary candidate for that, or what might be a basket of currencies based upon the BRICS, BRIC, that trading group.
Right.
Brazil, Russia, India, China, South Africa, which is expanding now. We're going to see Argentina join. I think they've already petitioned. Mexico is probably going to join. Turkey's going to join. I think Saudi Arabia will join too. So we've got this whole trend, and the bigger that block becomes, the more they're able to trade in their own currencies or use a currency like the yuan or some new currency based upon a basket of goods of those countries' various currencies. That's very likely. And if that happens, then the demand for the dollar is going to decline sharply because the demand for global trade using the other currency is going to rise. So the demand for the dollar is going to decline. And that has major, major implications for the U.S. global economic empire that we could talk about.
Well, people are also going in for gold now too.
Yeah, gold is kind of a hedge, I don't think gold will ever be a currency again. There's not enough gold in the world to finance global trade.
Right.
I think there's something I've heard. I don't know if it's true, but I heard a statement. You can put all the gold in the world in 10 Olympic-sized swimming pools.
Yeah,
right? That's not enough to finance trade. That's why we don't have a gold standard anymore.
Right.
If you did, global trade would collapse. But having gold as a kind of reserve supporting the new currency, that's quite likely.
I was going to ask you with the new BRICS currency, because there's still a lot of tensions between, say, like India and China, but it does seem like everybody's getting on board with some kind of alternative to the petrodollar. Do you think it's likely to be a basket of currencies? Because particularly with the geopolitical tensions between some of the bigger countries in BRICS?
Well, we don't know whether it'll be a basket or whether it'll be a basket of currencies is a politically easier way for these countries to trade in something other than the dollar without just going straight to the China yuan. See, it's an interim kind of a solution here, and it doesn't mean that these countries won't buy and sell anything in dollars. They'll still use the dollar, but it will be a competitive currency. It won't be as dominant as it is. And here's an important offshoot: if countries aren't trading in the dollar, then the U.S. doesn't know if they're violating the sanctions. You see, because linked to the dollar is the international payment system, the SWIFT. That's an acronym, SWIFT International Payment System, and it's that payment system that goes through U.S. banks that the U.S. is able to look in on these countries to see if they've violated the sanctions and they're buying Russian oil or whatever. So if the dollar goes, so does the SWIFT. And maybe the SWIFT goes even before that as, certainly a competitive solution has been talked about by Russia or China as an alternative to the dollar. What you see are these key institutions of U.S. global economic empire are being challenged now, and they're under a lot of pressure. And you'll see alternatives to the IMF and the World Bank and so forth develop. And that's a harbinger of the decline of the U.S. global economic empire. And the U.S. knows this. And that's why, in the last decades or so, it's becoming more aggressive and resorting to military action, force. Whereas in the past, when it was totally dominant and this economic empire was secure, it could just sort of give a warning to a country, we don't want you doing that. And if you do, well, then, we're going to not give you access to dollars or something like that. A good example is what they tried to do with Venezuela. They tried to choke Venezuela off from dollars. So being able to trade to buy dollars by selling their oil, or being able to buy things with their own currency, the bolivar, they couldn't do it. The whole idea of squeezing Venezuela was to take away their gold, take away their company Citgo in the U.S. that was earning dollars, to deny it dollars. And that puts a great squeeze on a country domestically, and you get a lot of political instability when you get shortages and runaway inflation. Well, that's the power of the dollar and the U.S. economic empire.
I have a super chat here. Let me see if I can pull that up. 1 second. In the meantime, everybody, now is a good time to hit like. Super important. And to subscribe. We're about to hit 15,000 subscribers this month. Here we are. 25% of businesses only being just profitable enough to pay their debt, plus collateralizing their debts / loans, plus the Fed increasing interest rates equals ?
I think we have a real question coming up with the debt ceiling and the Republicans as well, because if they are going to try to push through their austerity at the moment where it looks like we're about to have a credit shock, and if you look at both business and household debt, there was a brief downturn in like the first year after COVID, and then it's like blown up to higher than it's been in a very long, I think higher than ever. And so if there's a credit crunch, basically what seems to be keeping all the families going right now is about to fall apart, and we're going to get rid of stuff like food stamps. So I think we're likely to see some pretty big political instability, and it's very hard for me to know, and I don't, who's going to take the political hit for it, because we have a Republican Congress, but a Democratic Senate and a Democratic president. And I think a whole lot of this stuff is coming off at a time where it's going to be really destabilizing. And my fear is, and I fear this not because I necessarily think it's good for the world for the petrodollar to continue to exist. I think it's objectively bad, actually. But my fear is this triggering the way it does, the United States starts to look a lot more like, say, Great Britain right now, which is in a very bad situation. But we have a lot of military, and they tend to do stuff. And it seems very clear that there's an attempt to at least ramp up a Cold War with China based off this. It's not if people like John Marsheimer have their way, a hot war. So I'd like to hear what Dr. Rasmus says about all that.
Well, there's a lot in that. Well, let's take the question of debt. Let's deal with the government debt, which is now about projected to be at $31 trillion. That's up from $4 trillion 20 years ago. 31 trillion. How did we get here? How did we get from 4 trillion debt in 2000 to 31 trillion today? Well, one thing we did was we cut taxes, 80% of which were for investors and corporations and businesses and the wealthy. How much did we cut? $15 trillion. We cut $15 trillion over the last 20 years in taxes, most of which I said going to capitalists, right, in one form or another. Right. We spent $7 trillion on wars. Okay, so that's $22 trillion there, right? We had a big crisis, crash of the economy in 2008-9, which when that happens, of course, the government does not get the tax revenues when you got massive layoffs and businesses not producing and selling. So that adds to the problem. And then you get under Obama a very weak recovery for essentially 6 years, about 2/3 of normal following a recession. And then Trump comes along and passes a $4 trillion tax cut, mostly for businesses, especially multinational corporations. Not $1.5 trillion, $4 trillion. I can explain how. And then we have COVID, and we have another crash of the economy and another lack of revenue coming in. And that, of course, creates deficits, and deficits create the debt. And then, of course, now we have this run-up. Well, we've had a steady run-up in Pentagon and defense spending. Pentagon spending, $850 billion here in the latest, but really defense spending somewhere around $1.2 trillion by the U.S. when you add all the other spending that's military related, but it's not in the Pentagon. Okay, so there's this $25 trillion of your $31 trillion debt right there. Where did it go? Where did it go? Well, one of the places it went is into the coffers of big corporations. How did that happen? Well, the tax cuts, one thing, but the low interest rates, which allowed big corporations from Obama and under Obama and Trump to simply borrow huge amounts of money. And even though they were sitting on tons of cash, borrow huge amounts of money by issuing corporate bonds and giving it to the shareholders in stock buybacks and dividend payouts. How much just under Obama and Trump? About $15 trillion in stock buybacks and dividend payouts just for the Fortune 500 companies. There's a lot more corporations who were doing buybacks and dividend payments, so that the corporation is the conduit. And the fiscal monetary policy is just directing this flow of income and wealth through the corporations and into the hands of the wealthy capitalists and the shareholders. And that's the big problem we've got here. We talk about the income inequality. Well, wages are being held down for a whole number of reasons and really retreating in real terms. And we have this process going on where this fire hose of wealth being directed by policy, fiscal monetary policy, tax policy, interest rate policy, into the shareholders, the capitalist shareholders. And that's why you've got this massive income inequality and wealth inequality growing in this country.
Which reminds me, today is tax day. Pay your taxes or not. If you're rich enough, you won't be paying them.
Well, 60% of the deficit, this is a good figure, is due to inadequate tax revenue, which is due to tax cuts or slow growth or collapse recessions, you see. Mm-hmm. 2/3 roughly of the deficit, the 31 trillion, has to do with the policies that are not generating economic growth in this country anymore. And we're having these big crashes going on. Right, 2008-9, COVID related, and slow growth in between. Here's a figure for everyone to consider. Mm-hmm. When we got into COVID, when COVID hit, March of 20 and into 21, there was follow-on fiscal policies. Right, when COVID hit, the government spending about $2 to $3 trillion. Congress did, but the Federal Reserve gave banks and investors $5 trillion. That's not part of the deficit and debt. That's a separate box, you see. The Federal Reserve debt is about $9 trillion, right? 31 trillion for the rest of the government. And then you got state and local government, $3 or $4 trillion debt. But the point is, $5 trillion was pushed into the banks immediately after COVID began, $5 trillion, allegedly to bail out the banks. They didn't need bailing. It was a pre-bailout. In 2008-9, they needed bailout. This time they didn't even need it, and they were given $5 trillion. And then we have $2-3 trillion in fiscal spending. $8 trillion was pumped into the economy in 2021. What kind of growth did we get for that? If you look at GDP from December 31st, 2021 to December 31st, 2022, what kind of GDP economic growth did we get for that $8 trillion? 1%. Don't tell me something's not broken. Badly broken. And they're trying to put patches on it. But when you pump $8 trillion and all you get is 1% real growth, you get a lot of inflation, but 1% real growth, you're in trouble economically, I believe. And of course, we're slipping into a recession, deeper recession. We've been in a recession since the beginning of 2022. We had a technical recession, as they say, the GDP, 2 consecutive quarters of negative growth. In the second quarter, we had manufacturing just continuing to collapse, housing continuing to contract as well. And then only the services sector is really holding up the economy, barely. And now even that is going to contract. And the Fed wants to cause services to contract anyway, and it's going to do that. So we're going into a deeper recession here, no doubt about it. The banks have already pulling in their clause here about the bank lending. That's already happened. The credit crunch is here. It's beginning. So the scenario is not very pretty. And of course, whenever there's a crisis, what did the politicians and capitalists do? They start wars to distract everybody from it, right? And that's what's going on too.
Right. Well, let me ask you this question. To quote the Daily Wire, the recent blip in the U.S. banking sector, Reed, Silicon Valley Bank, and Signature Bank crisis, had only made things work in the right direction. Do you think that's true?
Well, who is the commentator, and what does he mean by right direction? I presume it means slowing the economy. And it's true. The Fed can raise interest rates to slow the economy. The whole idea raising interest rates is to slow down bank lending, right? So if you get a banking crisis and that causes a credit crunch and slows down bank lending anyway, well, then it's doing what the Fed wants it to do without raising prices even further, right? I think that's what that statement kind of means, in the right direction. Well, if you think recession is the right direction, then I guess it's right.
I think they were I thought they were trying to say that those crises were making things more stable because people weren't going to make those mistakes anymore.
Well, capitalist bankers will always make the mistakes of investing in high risk for high profits. Yeah. Unless they're regulated. And part of the problem with the regional banking crisis was they lifted the regulations in 2017 on these regional banks. After the regional banks were lobbying heavily for the politicians to do that. And they did it in 2018 under Trump. All right. And we see the consequences of that. Part of the regulations that were passed after the 2008-9 crash was that banks had to keep at least 10% cash on hand for when people want their money, for whatever reason, right? Well, that was eliminated for any bank with revenue of less than $250 billion, which is most of the regional banks, you see. They're not $250 billion. That's the big 8 or 10 banks. That's Chase and Wells and Citigroup and so forth. But the regional banks, like Silicon Valley Bank and First Republic Bank and PacWest Bank Corp, all of these that we've heard about, Signature Bank, etc. They got a reprieve. They did not have to keep 10%. How much cash on hand did Signature Bank and Silicon Valley Bank have at the time of their crash? 1%. 1%. The average for the banks of cash on hand is 15%. And some banks like Citigroup have 25% cash on hand. They had 1%. The question is, why were they allowed to get away with only having 1% cash on hand? Well, that was because of deregulation, you see. The deregulation didn't cause the crisis, it enabled it. The cause of the banking crisis has to go back to the tech and crypto bubbles that went bust last year.
Mm-hmm.
That's the fundamental cause. The deregulation is what I call an enabling cause of it. But the fundamental cause was the bust. When it went bust and the Fed raised interest rates, going bust, banks like Silicon Valley Bank didn't have as much business and chance to make money, by funding IPOs and stuff like that. That all dried up. And at the same time, the Fed raises interest rates, which causes bond prices, to rise. And what does it do? Bond interest rates to rise, rather, not bond prices, right? Mm-hmm. So Silicon Valley Bank goes out and it buys all these treasury bonds because, it's a return, and they're not getting any return out of the traditional business, but they can get a return by investing in treasuries, which they do. But the problem is, right, when you raise interest rates, the treasury prices collapse. Mm-hmm. The interest rate goes up, but the price collapses. So they're sitting on $20-30 billion. This is Silicon Valley Bank of treasuries in which the prices are collapsing. All right. And at the same time, they only have 1% cash. And at the same time, they're risky, and the rating agencies like Moody's say, oh, this bank's in trouble. And then the VCs, the venture capitalists, right, which are deeply involved with Silicon Valley Bank, right, tell their companies that they launched, get your money out of Silicon Valley Bank. They're going to go under. Well, everybody had money in Silicon Valley Bank, like $200 billion.
Right.
Hey, we want our money. Well, Silicon Valley Bank says, I only got 1%. I don't got your money.
Right.
Everybody rushes. And then everybody starts looking around at these other regional banks that are exposed to tech or crypto. The same thing was happening with crypto at Signature Bank. Mm-hmm. You see? And they started looking there. Oh, we want our money. We want our money. Let's take our money and run. Well, as it so happens, Silicon Valley Bank goes under, and the FDIC only assures $250,000. But I think it was like 75% of all the depositors had more than $250,000 in Silicon Valley Bank.
Right.
So the FDIC had to say, well, we'll cover all of it, right?
Did they have to say that?
Yeah.
No, they didn't.
They didn't. No, they had to, or the banking crisis would have been
a lot worse.
A lot worse. It would have. You would have seen a dozen or more banks collapse if they didn't do it. I'm not saying that's the right thing to do, but that's the way capitalism works. You see, and the problem is still there. The Fed threw $400 billion at the regional banking system quickly in 2 weeks to try to stem the crisis. The losses were about $200 billion. Well, maybe more than that because, Signature Bank and First Republic Bank. The Fed opened up its spigot and threw $400 billion in a matter of a couple of weeks at the system. When the capitalists and the bankers need it, boy, the money's there, isn't it? Yeah.
Right.
But when people need it, we
don't know how to get it to the people.
Yeah, we can't afford it. It's going to cause debt and so forth. All those happy answers.
Exactly.
All the bullshit comes out, right?
That's right.
But when banks need it, boy, it's there. And like I said, they got $5 trillion. They didn't even need it. It was like a pre-bank bailout. We never had a pre-bank bailout before. That's what this was. Mm-hmm. The pre-bank bailout in 2021 was bigger than the actual bank bailout in 2008-9. That was about maybe $4 trillion. This is $5 trillion, and they didn't even need it. It just goes to show you that fiscal and monetary policy are now just conduits. They're just engines for throwing money at the capitalist class at the flimsiest excuse and opportunity.
Well, we don't want the economy to overheat, as Larry Summers says.
Well, it doesn't.
There's
It
a
doesn't.
danger of that.
It doesn't overheat because most of this money thrown at it does not go into goods and services. It goes into financial assets.
It goes to asset
around the world.
Asset inflation.
It doesn't go into the U.S. It goes into stock markets around the world, bond markets around the world, derivatives around the world. This is where the money flows to. It doesn't really get into the U.S. economy. Very little. Some of it, very little, gets into the U.S. economy anymore. But that's the consequence of empire and a global financial system and a global communication system in which you can move the money around instantaneously. That's 21st century capitalism, 21st century finance capitalism. And you got maybe, in the U.S., a couple 100,000 investors who have $25 million or more in liquid funds. That's the low end that they can move around. And then in Asia, you got maybe 100, 150,000 in Europe, maybe 200,000. So you've got maybe a 500,000 of these finance capitalists around the world who have this network of financial markets now, and they've created all these financial products and securities, derivatives, and so forth to play with. And now you got the internet and communications, and they just move their money around the world instantaneously. I mean, in microseconds, to take advantage of profits over here and there and so forth. And it's so lucrative and it's so profitable that they don't really want to invest in making things anymore. I mean, there's still some capitalists who do that, Musk and others, they make things. Right. I'm not saying that's disappeared, but if you really want to become a billionaire, you don't make things, because then you're going to get suppliers, and you're going to get workers, and, you got to raw materials, and you got to get a factory, and and it takes a while, and you don't know what's going to happen a year or two when you're ready to come online. It's riskier to make things. Capitalism, the real money is not in making things, it's using money to make money.
Varn?
I mean, we've seen over the past, since the late 70s, a movement to a more and more rentier economy. Started with neoliberalism, and financialization has continued through whatever we're in right now. I mean, it's some kind of, it's related to neoliberalism, but the mechanisms really changed when all that QE started hitting in the mid to late 2000s, particularly after the first housing crisis. And I guess that leads to stuff like people asking me, like, where did Elon's money go? And I'm like, well, it's just gone. It's like these were inappreciated speculative assets. When speculative assets fall and they're not invested in any commodity making, that when it's wiped out, it's fictitious capital. It's just gone. It's not like it went to anybody. That's like, because all that was based off of value speculation on financial assets. And that's where a whole lot of the seeming profit valorization in our system is right now. And when you hit like real production problems, it all of a sudden starts to show all kinds of downstream effects. And then you start seeing, I don't know, these tech rentiers losing half their income in a year. Although it's not like they were spreading it around very much.
True.
And I think one thing that we do have to deal with right now is there's a lot of even the left who now thinks that we could run an infinite amount of debt infinitely. And
I wouldn't call modern monetary theory the left. I think that's what you're referring to.
Why wouldn't you call it the left?
Why wouldn't I?
Hmm.
Well, because it's basically a monetary solution to the capitalist problem, and monetary solutions are very ephemeral. And basically, MMT is fiscal policy parading as monetary policy, you see.
Hmm.
And it's very naive because they think that they can change and reform the Fed to start providing money capital to real needs, right? Well, do you really think the finance capitalists in this country and the world are going to allow that to happen without a revolution? No, you're not going to get to MMT through advocating changes and reforms to the Federal Reserve System or the monetary policy of this country. So I think it's very naive. It's really an academic exercise. Now, if you had a true public banking system and the Federal Reserve was the public bank of banks,
Hmm.
well, then, MMT would work. But they're not going to allow a true nationwide public banking system, and they're not going to reform the Fed so that it doesn't serve the banking and finance capitalist interests. It serves the people's interests. No, they're not going to do that. That will take
Okay.
a political revolution first before you can get something that even vaguely looks like that. Now, I'm an advocate of public banking. I think
Hmm.
it's a good idea, but it's only going to survive in the interstices. It's not going to replace the current capitalist banking system or the global capitalist monetary system. They're not going to allow it to. Uh, it's like
I,
just like they're not going to allow producers cooperatives to push out capitalist production. They're
yeah.
I mean, you're talking about major political changes required. You can't propose these economic reforms that the political system will never accede to.
Absolutely, and this has been my critique of MMT for a while. I want to get into this though because there's a lot of people who think that multipolarity and all this will lead to a non-capitalist system and the global system, and because I guess because of a faith in China. Um, I wanted to ask you, uh, even with this declining empire, which I think we can all kind of see what's happening with that pretty quickly. And I think we even see in the United States military policy, like you said, it's both getting more aggressive in some areas, not enforcing small things anymore in others. Um, it, do you think that some people may be naive though that what is coming in this quote multipolar money world is not capitalism because they've associated capitalism with U.S. imperialism completely? Is it you know what should we make of that, and what would this change mean for global capital if it happens, if you do really see de-dollarization? Is it likely to still be capitalist, I guess?
Well, just because you change currency for trading of
Hmm.
goods and services doesn't mean you're abandoning capitalism. You just
Right.
have a different. I mean, the world used to turn on the British pound, right? And the dollar kind of replaced it. Well, did capitalism go away? No, right?
Hmm.
Just because you change and you have a competing currency, I don't think that fundamentally changes anything uh, from capitalism to something that's not capitalism, socialism, communism, whatever you want to call it, right? So no, I would not. You got competition now among capitalists here going on that you didn't have for decades when the U.S. was the big capitalist hegemon in the world, and everyone played according to its rules. They talk about the world rule order. Well, they mean their rules. The old joke. Whoever has the gold makes the rules. That's the golden rule, right?
Hmm.
And I think we're what we're seeing is some other capitalist countries or quasi capitalist countries even their economy is mixed. Part of it's uh, nationalized, socialized in China. Part of it's not. So it's kind of a mixed transition kind of a system over there. And of course, Russia is really a capitalist country, and so is Brazil, and so are the others. Well, these other up and coming capitalists don't want to play totally by the rules. They're big enough and strong enough. They want a better deal out of it all. And they don't want to be victimized by the dollar, when it rises and falls and whatever. They want more of a say. And they've been getting more of a say slowly. The G20 and so forth has been growing. And that's really what this is about here. Problem is the U.S. Does not want to give up being the big bad boy on the block, right? It wants to maintain the old system. That's why Putin talks about multipolarity, right? What he means is we want a bigger say in how the whole global economy runs. And the U.S. says no. We want to keep running it the way we did. And we're going to circle our wagons here with the G7, the Europeans and the Japanese and the Australian, New Zealanders, that's Canadians, North America. We're circling the wagons, and we're going to resist this. And you got the BRICS saying, well, we're going to go our own way here to some extent on some things. And you got the rest of the world who are kind of watching at both sides here and figuring out how can we play both against the middle here, and that's kind of where we're at geopolitically.
Do you think that's what we saw with France last week when it went to China and then came back talking about multipolarity and maybe moving away from the dollar? Is someone trying to play both sides off of each other?
Yeah, Macron and the French always talk both sides of their mouth. That's a tradition in France, I don't think there's much. He wants to look important and big, because he's in trouble at home. So he goes to China. He didn't get anything out of China, Who knows? I think maybe Macron goes to China to try to make sure that Europe and China can keep trading despite the U.S. policies. It's kind of like a backdoor insurance policy, I think. Or maybe there's some talk about he goes to China to see if he can influence China and kind of brokering some kind of armistice in Ukraine. I think maybe those were the two things he went to China for, as well as the domestic political exposure, as well as his ego. I think that's part of
it. One other thing I think that we see now that we haven't seen in a long time is most of the developed world being both economically and politically unstable at the same time. And I know I've been actually surprised how quickly Europe showed its economy to be pretty fragile. So is there any things we should be thinking about as leftists? We don't have a whole lot of influence on economic policy. So what should we be doing right now?
We, you mean you and me, or
yeah, you and me. You and me, people who like leftists who can organize but do not have state power.
Oh, well, that's a totally different question. In the U.S., it's a big question in the U.S. I've always said there's only one real issue in the U.S., and that's the organization question. The U.S. has working people in the U.S. have no organization to express their discontent or to frame alternative proposals. We're totally atomized and fragmented. If you look at France, you got these demonstrations. Well, that's because the unions have endorsed them, and they're trying to lead and contain and direct the popular uprising going on. And they've got their own and all kind of independent parties over there. And here in the U.S., we got neither that. Certainly don't have any independent parties. And the unions are the leadership at least are tied to the apron strings of the Democrat Party. They're not going to do anything that embarrasses them, the Democrats, because they're waiting for a handout when the Democrats win office next time. If they do, they always deliver the votes for some crumbs. Except the crumbs are hardly coming anymore. But if there's no other game in town, what are they going to do? Are they going to try to create a labor party, or lead some change or something? No, they're not. They're not ever going to do that. So economically and politically, the American worker is atomized, fragmented, and you can't really expect them to do what they're doing in France. Let's go out and throw up the barricades and light up some tires or whatever, down on Pennsylvania Avenue. Because workers aren't stupid. They know they're not going to go out there and stick their neck out if there's nothing behind them. It's a big problem in the U.S. It's the organization question, I think, which is the single question. And until people who lead real movements at the grassroots, real movement leaders, not intellectuals, academics who call for a party, top down, call it and they will come, kind of like that movie, Let's Build It and They Will Come. That's not how parties are formed. But until real people who are leading real movements come to understand that they've got to create an umbrella and they got to come together in a founding convention, maybe regional to national. That's the only way you're going to build a political alternative. Of course, it's a lot more difficult in the U.S. because you don't have a parliamentary system, and you got political parties doing everything they can to even prevent you from getting on a ballot. They've got the system locked up politically, very tight. So it's, what can we do? I think all we can do is prepare and educate people that that's the only solution and come up with alternatives. And when people feel, they're desperate, maybe they'll take the next step. But people will always exhaust the easy way out first, always. I was a union organizer and a local president, contract negotiator, strike coordinator for 12 years, 13 years in my younger days, and very, very clearly, workers don't take the drastic action until it's clear there's no other way out. And it's not clear to them yet. There's no other way out. As long as they keep voting for Democrats, it's clear. They haven't come to that point. Okay, we're talking politics, not economics.
Yeah, fair enough. I think MT has a question. All right.
Wow. Okay. I'm sorry. My computer froze for a minute there. I've got one last question to wrap up. So this is a quote from, I believe, Daily Wire again. Then why this newfound fad to give up dollars? The West and the US are increasingly moving away from fossil fuels. In fact, both the EU and US are bringing in new regulations that will make it harder for emerging economies in Asia, Africa, and Latin America to trade with the EU and US. What are your thoughts on that?
Moving away from fossil fuels
is causing a need for using a basket of currencies. I have not heard this anywhere else.
I don't see the connection between moving to alternative energy and the alternative basket.
Mm-hmm.
It's currency. I'm sorry, I don't see the connection there.
Varn, do you see anything there?
That seems like
there's like two separate things there.
Yeah.
How they?
I feel like
they connect.
Yeah.
I'm not so sure.
Yeah.
It feels like it's greenwashing. Like it's like, oh, we're de-dollarizing because we're doing the right thing, and it very much feels like spin. Our very very weak spin too, because I also don't see why, like, okay, if we move off, even if we were on a lot more alternative energy grids or whatever right now, we still use a ton of fossil fuels to like in the production of commodities and whatnot, and not even just in energy. I don't see how that would change that. Plus, we'd be buying stuff in dollars and building it here, and that none of that's really happening.
The number one in the world largest consumer of fossil fuels is the U.S. military.
Mm-hmm.
That's the biggest, and I can't imagine a jet aircraft running on lithium batteries yet. Okay, or tanks running on lithium batteries. So yeah, I agree with you. Oil is going to be around a long time, and you're going to have alternative energy, and that will raise the price of oil because the supply of oil will be less, and therefore will keep the revenue up for the big oil companies, and they will diversify into alternative energy wherever they think they can control the market. It's a slow process. That train's left the station. We are moving to alternative energy, but too slow. One of my arguments is that they won't make it to the tipping point here. Capitalism will not be able to solve the problem of climate change and global warming before we reach the tipping point. That's a big crisis for it, a big contradiction for it. The other big contradiction is the U.S. Capitalism and its military are running amok now. They're being challenged and they're panicking, and they're looking to provoke wars. They provoked the war with Russia and Ukraine because the Rand Corporation in 2016 said you better deal with Russia first before you go after the real opponent, which is China. And that's exactly the plan that the Democrats had under Obama in 2016 that got put on the shelf when Trump came in and quickly got brushed off as soon as Biden got back. And that's why they rushed out of Afghanistan and rushed right into Ukraine and the war in Ukraine, because they're going to deal with Russia first, debilitate it if they can, get it immersed in a long war like they got in Afghanistan in the 1980s. I call it Brzezinski 2.0 document strategy here. Brzezinski, it's big news. Brzezinski was an immigrant who actually was a Canadian, got into Harvard in the right position, became a national security advisor to Jimmy Carter in 78, 79. And in his memoir, he reveals that he went to Carter in July of 79, said, we got to destabilize Russia. Let's suck them into Afghanistan. Let's destabilize Afghanistan so Afghanistan calls in the Russians, and then we'll mire them in a long war. We'll make a proxy war. We'll fund the Mujahideen, which is what they did. And economically, it debilitated the Soviet Union, played a role. Well, I think they believe Ukraine is the same thing. The U.S. does not want a solution to this proxy war. They want it to continue. They want to debilitate Russia. And when they think they've done enough of it, then they'll go on to China. And they're preparing for China as well, you see, around Taiwan and so forth. But the Chinese are too smart. They're not falling for it. And they're not ready for a confrontation with the U.S. Yet. So the U.S. is provoking wars. They're looking for wars. They're panicking. It's the wolf that's been cornered, and he's coming out snarling, right? And I think some mistakes going to be made along the way, you see. Someone's going to pull the wrong trigger, I think, along the way if this continues. And then thirdly, I think the major contradiction is artificial intelligence, which is going to cause massive unemployment. Goldman Sachs just reported 300 million jobs are going to be lost or reduced in hours here as a result of artificial intelligence. And capital. That train's left the station. They're going to do it. And simple decision-making jobs are going to be eliminated by the millions. And what's going to happen then when you have even millions more jobless, and you got a deficit and they don't want to pay unemployment or universal basic income? What's going to happen? Those are the three great contradictions I see with capitalism, and why I don't believe it's going to make it past the mid-century. So we're going to see some really interesting times over the next decade or so.
Wow, that's tough talk. That's very sobering. Thank you so much. You are a
Well,
wealth
you
of
did
information.
introduce me as the Dr. Doom 2.0, right?
That is correct. That is correct. Thank you so much for your time, Jack Rasmus. Thank you,
Okay.
Varn. And this is Revolution. We are out.